My name is John Huber. I'm with Wells Fargo Technology Banking, and we're going to talk about the marketplace from a slightly different perspective. It's kind of the operations. In this case, it's going to be kind of the payment marketplace, and then also the legal and compliance, kind of what you need to have in place to be able to scale user growth. So we think about marketplaces all the time. I think one of the most exciting segments in the industry. They also are very good customers. They tend to consume a lot of bank services, but more directly, they're just so fundamental to any marketplace economy. You think about, sellers need to be paid quickly. Buyers need to be, and have authentication in terms of, the types of goods they provide. More fundamentally, that's how buyers and sellers find one another. It's how prices for assets and services are set. There's discovery. It's like just absolutely foundational, again, to any economy. And while there's all kinds of new tools now, and the rate of kind of capabilities over the last 5 years is tremendous, from AWS to mobile commerce to better shipping and inventory control, the fundamental premises are the same now as they've been for centuries. Again, I get back to the earlier point, which underscores our two main areas of discussion. Sellers like to get paid, faster is better, and buyers want a safe and trusted marketplace, and they want to have authentication.
Can we get it turned up?
It's hard to hear in the back? Maybe I just hold it closer to my mouth. So the first bit, that sounds a little bit louder. Got it? Okay, thanks. So as it relates to the operations, I would say it kind of touches the most important thing for any entrepreneur out there. If you don't have a good sort of payment infrastructure, you can't achieve any kind of operating leverage with scale. So these are fundamentally flow businesses where your revenue is a function of a take rate or a percentage of the GMV that you process. So as that revenue number goes up, you have to have some scale advantage, or else your operating expenses just march in lockstep, and I'd argue there isn't much point for growth. So the payments aspects really drive quite a bit of this cost, and it's not so much, well, what are the payments costs or the cost of returns? It's people. You can't just keep adding more and more people to solve what I'd say is fundamentally something that should be handled on a business or machine-to-machine basis. There's all kinds of payments tools that make sense at the outset as you grow farther, and then Rohit from Funding Circle is going to talk about kind of the evolution of of his company and how we thought about payments to achieve scale. And the second, and I'd say probably as, if not more importantly, and which has really come to become very, very relevant in the last few years, is compliance. And historically, the supporting banks kind of gave you all a hall pass in terms of customer registration. How do you think about compliance? How do you think about AML? We'll kind of work with you as you grow your business. And I'd say that has come to be front and center. So if you don't have a good compliance program and have some ways to figure out who the bad guys are to ensure or provide us the transparency in terms of who your customers are, I'd say there's very little appetite for the top 50 banks that have the scale and the tools you need to affect customer satisfaction. So operational success and compliance are the focus for this. So Rohit, I'd like to start with you. First, a little bit about Funding Circle for those who don't know. Funding Circle is an online marketplace for business loans. It was founded in 2010 and it's headquartered in London. It's the largest P2P lender in the UK with over $5 billion USD in loan volume since inception to over 40,000 businesses globally. It has its headquarters here in the United States, in San Francisco. Rohit leads the product and design teams that are responsible for Funding Circle's investor products, core financial systems, and data products. Welcome, Rohit. So as you scaled, how did payments process and personnel evolve, and what inflection points did you hit, and how did it impact product development?
Sure. Thank you, John. So the way, just some context, the way we think about payments and marketplaces, the marketplace is the core for our business, and payments is a part of it. So what the marketplace platform really entails is the matching of borrowers to investors, because that's what we do. We match investors with borrowers who need financing. the process and the mechanics of taking money from investors and giving it to borrowers, and then on the return flow, taking repayments from borrowers for those loans and distributing it to one or many investors. So that's kind of what our marketplace system, which payments is a part of, entails. So for us, I think as we started in the early days, most of that marketplace processing was pretty much manual. Like any startup that starts, we focus more on customer acquisition on both the borrower and the investor side, and volumes were relatively low, so you could kind of process things manually. But you soon realize that once you found product market fit, you're not going to get any operational leverage if you continue on that route. Because your headcount will scale linearly with the number of transactions, and you're really not going to be a sustainable business because you have no operating leverage. And moreover, manual also makes it hard to be really an eye on compliance, and regulatory risk becomes higher with the number of transactions, because now if it's manual, there's risk of error, etc., a risk that we did not want to take. So that was kind of as our volume started to shoot up in 2015, and we're a global business, so we're actually in multiple countries. We're in 4 countries today. That we quickly realized that that's not possible for us to scale that way, and we really have to shift our focus and build a marketplace platform that is with the core principle that we have to automate everything. Our core principle while we build these platforms is that our operations teams are going to only operate by exception. And a way to think about it is we want them to be detectives that look at corner cases and edge cases that can't be automated. But the routine work of just making factory widgets, the machine should just take care of itself. And that's what we've really spent our time and focus and energy in, building a platform that automates everything and works by exception, so that we have a lean operations team. And the way we had to, it was a strategic choice, like that is our core business, that is how we're going to get operating leverage. So we had to allocate a large amount of resources and make it a strategic priority for us to actually make that happen starting 2015 onwards. This is the largest number of engineers, or almost 9 to 10 teams, work on just these core marketplace systems, because this is so fundamental to our business to get operational leverage. So that's kind of been our journey.
So there are a lot of good payment tools out there. I'm just wondering, how do you think about third-party solutions? I mean, we have many clients using Stripe or Adyen or WePay, or there's a plethora of others. How do you think about, outsourcing it versus developing it in-house, and sort of when did you start, incorporating that?
So it really depends on what your core competency of the business is and what is your core value proposition. So for us, for example, the actual payment rails of interacting with the card networks or interacting with the banking network for ACH or wire and, say, direct debit in the UK is not our fundamental core business. That is a way to get money into the system, but the core business really is matching the borrowers and investors. And once that money enters the system, how do we transfer it to the borrower and make sure that when money comes back from the borrower, we send it back out to the investor, all in a compliant and regulated and automated way. So with that kind of mindset, we're really not interested in remaking Stripe or remaking Adyen or remaking Wells Fargo functionality. We're just going to integrate with those guys. Our core value proposition is, once money comes into our system, how do we manage that? And that's something that we build on our own, because we believe that's core IP. That's something that's unique to us based on our marketplace model, where we don't see software outside the market that can actually try to satisfy that need. So again, it really depends on what your core competency is. For us, the payment rails is not, so we choose to integrate and spend most of our energies in building out the automation for the marketplace system. So depending on your business, that might be different, and you've got to kind of make that choice.
Just maybe to amplify that point a little bit. So do you see payments, is that part of product and product management, or is it IT, and sort of how do you allocate resources over the two? I find it interesting, your business is unique, that the payment engineer is part of product management. And kind of when you're doing budgeting, like how do you split resources between just core IT and then sort of the payment aspects of product?
So one way to think about that is generally, I would say, new fintech versus, say, old companies that use, or incumbents that use technology. There's this differentiation between what's IT and what's engineering. Typically in our world, we think all of that is engineering, and IT is really just corporate IT, which is managing the laptops, managing the desktops, making sure that the Wi-Fi works. So that's kind of how the split we think about, which means that all the payment operations and the integrations is all managed under the product umbrella set, because that's what really drives the business. And that's where we allocate resources. Where finance gets involved is the output of the reporting. So we provide data to finance, who can report out to either the legal team or to our business partners. But in terms of selection of the vendor whom we want to integrate with, how are we going to build our internal systems is a core engineering activity, which is very important for the success of the business, which means that it is something that is managed by the product and development teams rather than just a IT team that's sitting behind somewhere and just putting stuff together. So that's kind of how we think about it.
A couple more questions. We'll get to Deb. Briefly, how do you think, like when you think about payment friction in terms of the customer experience, like how big a part of overall satisfaction is being paid quickly, or if there's returns, how quickly their payments are returned? Like, have you assessed that with customers at all, and how do they think about it?
So definitely speed is a very important factor. And it's almost like it's become table stakes now. I don't think you can get sustainable competitive advantage by being faster than somebody else, but there's a base level of speed that you have to be, even if you have to matter in the market. So for example, on our end, the borrowers do care that money gets deposited to them really quickly. We want to make it easy to collect their bank information from them so that we can deposit the money in the right account. And the same with investors. We want to make it really easy for them to deposit and withdraw money from our platform, and also them to receive distributions from our borrowers. But that's almost table stakes now, that if you don't do that, you won't even matter, because that's what the business is today. That doesn't really provide a lot of competitive advantage. I think the competitive advantage really is in the kind of efficiency and the operating leverage you get between those two places, which is your core marketplace. That's where you have an opportunity to really competitively differentiate, because that's something that you can control, the experience for your internal users that you can control, and the levers of growth and the levers of operations that you can control that really can squeeze margin out of that business. So that's kind of how we think about it. Payment friction is super important, but it's almost like it's a table stakes now. You can't really use that as a competitive advantage, that I am 10 seconds faster than the other guy, because the other guy will also be 10 seconds faster than you. It's just always going to be super fast now, and that's an expectation that customers have.
Thanks, Rohit. And we'll have time for some questions at the end if you had some follow-up with Rohit specifically on payments. I'd like to introduce Deb Thoren-Peden. She leads Pillsbury's FinTech, Payments, and Blockchain team, its consumer and retail industry team, and its cybersecurity, privacy, data, and security and information use team. That's a lot of responsibility there. I'm going to ask a very broad question, Deb. Everyone talks about compliance, and I think everyone has a different perspective of what it means, but what are the main issues for marketplace administrators? Is it primarily around money laundering or BSA, and is this the customer's problem, the administrator's problems, or is it really more of an issue for the banks?
So I will say compliance can certainly be one of the more painful aspects for marketplaces. It can always be dealt with. One can always work through it. But it is not normally the case that one can turn to an Aiden or a Wells Fargo and go, gee, we're now outside of all of this. As a matter of fact, that almost never, ever happens. So one of the things that is always important, preferably when setting up a marketplace, if one can, ahead of time is good. Certainly as one's expanding, and especially if you've got international, is to have somebody, whomever you want, sit down and sort of work through the core business and exactly what services you're going to be doing, as well as the exact flow of funds and who's touching the funds and what you're advertising. And the reason I say that is compliance responsibilities will vary depending upon those answers. So, for example, in most parts of the world, certainly in the U.S., if you are handling funds that belong to somebody else, right? Generally speaking, unless you're selling your own goods and services and you're just like a store getting paid directly, which is not often the case, or sometimes the case for marketplaces. But if you're handling monies that belong to somebody else, generally speaking, you need to have a banking license or a money transmission license. Rationale for that sometimes helps in terms of, I know that seems outrageous, but the reason for it is because if that third party is handling monies and if they go bankrupt, that money disappears. So the underlying reason for those very painful compliance requirements is because they want to make sure that the money's protected and it's in a place where it's not going to disappear overnight. So John's right in terms of, so that will trigger issues such as, do you need money transmittal licenses, or do you have to work with somebody who's got one? Can you work with the bank? Sometimes yes, sometimes no. Do you need lending licenses? Depending upon what you're doing in a marketplace, if you're giving loans, you may need to have lending licenses as well. So there's that portion in the payments laws. There's anti-money laundering and anti-sanctions laws. Obviously, the more a marketplace is international, that more that comes into play. Doesn't mean you can ignore them on the front end, and depending upon who you're working with, they may have very specific requirements in terms of know your customer and information that's obligated to be captured. Also the system rules, depending upon, if you're with Visa, MasterCard, Discover Card, Amex, they all have their own rules as well that will overlay on what you can and can't do. Clearly today, and I think everybody is particularly aware of this, but it's always really been true, handling of data and privacy of data and what you do with that data and who you share it with and how it can be obtained is core. It was stepping back from a business perspective. For most companies, their most valuable asset is their customer information. It depends upon the business, but that's generally the case. So understanding, especially in a marketplace context, what information for your business you're looking at using, what other people want to use, and particularly for what you want to use, can you use it? Do you have to get consent of the customers to use it? Sometimes that is the case, by the way. It is usually the case that under the banking and privacy laws that if information needs to be shared to get a payment accomplished, it can be shared for that purpose, but it cannot be used for any other purpose. So it's not like Party B now gets it in their databases and gets to run with it. That is not the case. They do not get to run with it. They may only use it for the first purpose and not for any other purposes. So that's a hard thing to sort of build in. And sometimes depending upon your marketplace and who wants to do what, you may have to build in affirmative consents, opt-ins, opt-outs, depending upon the states. If you're trying to get information to text people, in the US, basically you need to have an affirmative consent to text that's been obtained. Sometimes you need to put people through electronic signature, e-sign requirements to be able to even capture that and send them notices. So those are some of the biggest ones. More tricky ones are obviously, again, more in an international setting. We've got extensive economic sanctions laws. They're the ones that you see about the Ukraine and Cuba. Actually, they started back in the Civil War, so they're not new. It's just they seem to change daily. Those laws are immediately effective. There's no grace period in terms of those. Once they happen, that's it. There's no de minimis. There's no sort of, gee, we didn't know excuse for those. So lots of companies have built in very solid OFAC screening is what it's called, to just try to make sure that they've got compliance there. So those are, then you get into more interesting issues in terms of like sometimes cross-border. Do you need additional, like the directives and the payment directives in UK, which also let you passport across other countries. But part of it, especially for marketplaces today, is are you only offering in the US? And you've got all the state laws in the US. But if you're doing cross-border, you've got to figure out all the other countries' laws too. Because most countries have very comparable laws to ours. That was perhaps more than you wanted me to say, but...
We have a couple more. Oh, here we go. Briefly, and I think maybe you answered it, but for the entrepreneurs in the room that have a limited budget, should they think about hiring a compliance attorney in-house now? When do they need to bring this process in-house, or can they just rely on external counsel?
I think you can, well, especially if they're limited budget. I don't always know, and I've been GC of startup companies, so I've been on the forefront. I was probably employee number 5. So depending upon the company, sometimes it makes sense to get them in, but generally that would not be what I'd have a company spending their money on the beginning. You can hire attorneys. You can sometimes hire consultants to help on compliance. You don't have a full FTE for compliance. That said, at some point, fairly rapidly as the company's building, probably getting somebody in-house, or at least part of the time in-house, is going to be helpful. Amongst other things, the biz dev people will always have 1,800 contracts going on. the chair will want to be, offering some new product and service in some new country tomorrow, and so sometimes it can actually be cheaper, but I don't tend to think that that's for brand new startups for the most part, unless they're dead center of payments and this is literally what they want to do.
Do we have time for questions? We have a few minutes left. If there's any questions from the audience, love to hear them. Yes, sir.
Sorry, just picking up a little bit on what Deborah was saying, and without getting too technical in my question, with OFAC screening and compliance for cross-border situations, in particular with startup marketplaces that are really basically like cross borders. What are the trigger points? And I know you said that there is no de minimis when you talk about sanctions, for instance. But for instance, how early and what would you advise smaller, under-resourced startups to handle situations in terms of know their customer? How far can they go, or are they expected to go? And I'll give you one example. I have a situation where I'm a client, I'm not an attorney, I'm a strategist, where all the paperwork for their client, which is basically buying things from them in this case, and they have a bi-directional relationship, are fine, clear, and everything. But it was discovered later on that if you dig deeper down, that one of the owners of that entity may fall under a jurisdiction that had sanctions on it. There were all sorts of questions, but they could not possibly have known that prima facie just on the surface.
Sure.
What is expected in a small company compliance like that?
In the interest of time, it might make sense to go offline with Debbie.
Sure, that's fine. I apologize.
Sure.
I don't mean to.
I'd be happy to answer
I
that.
apologize. No problem.
No problem. I'd be more than happy to answer that afterwards for anybody who wants to listen. You've got a question?
Yes, sir.
Hi. What, if any, compliance considerations would you have around taking a payment for a service to be delivered in the future?
Okay. Well, generally speaking, if you're taking a payment for a service to be delivered in the future, one, the system rules have very strict rules in terms of when you can do it, right? And what you have to have agreements with on the customers. Two, depending upon whether you're holding those funds or not, you may actually be triggering what's known as prepaid access rules or stored value rules. Because really, if you're holding money that belongs to somebody else, unless it's for your service and there has been an appropriate agreement that you're not going to be providing that service until later, like if you're really holding it for some third party, then you're back to you are now holding value that belongs to a third party and you've taken it in advance. So that is one of those things that again, if you are the merchant and it's merely your service and goods, there are ways to build that into the receipts and what people have agreed for. Like I can buy stuff in November to be sent to my family in December, right, if I want to. But some companies have that as a bit of a business flow process, and sometimes they do that to try to get more float on their income, and that can be very dangerous and actually potentially very problematic.
I think something to be baked into the terms or something like that.
Sometimes it may not even be the terms, because the reality is if it's prepaid access, you've now triggered a whole, there's no consent from a customer that would get you out of some of the banking laws. It just triggers other obligations for you.
We're being signaled that time's up, but please join me in thanking our speakers.
Thank you.